Hi, I'm Thomas. Welcome to the Parachute Advice Podcast. My life has taken a lot of twists and turns, and on this podcast, I will dive into those experiences. The goal is to help everyone listening learn from my experiences and hopefully avoid some of the mistakes I've made. Hi, welcome to today's episode of the Parachute Advice Podcast. I'm your host, Thomas. Today, I want to discuss retirement planning. As I've mentioned through several episodes and will continue to mention throughout the podcast, a holistic approach to your life is key to mental and physical health. To that point, retirement is a major aspect of your life. I cannot begin to drive home just how important it is to start as early as possible in planning for retirement. Think about this crazy idea. If the day your child is born, or the day you were born, you would put $6,500 into an S&P 500 index fund, and saw a moderate annual rate of return of 8%, at the age of 65, you would have $960,000. This is with never putting another dime into that fund and getting a rate of return on the lower end of the historical average. Yes, it can be that easy if you start early enough. Okay, let's dive in. To the point of starting to save as early as possible, the most important thing is if your employer offers a savings program, participate in it. If they offer any form of match, make sure you're taking advantage of that. It's free money. For example, my employer matches your first 6% with a 3% match, meaning if I put 6% in, I am automatically making a 50% rate of return on my investment just from match. What is scary is, according to a CNBC article, 17% of workers with access to an employer-sponsored plan don't currently contribute, and among those who do, 12% or 17.5 million people leave company matching funds on the table, according to the recent survey by Magnifying Money. That's a lot of free money being left on the table. I'm sure your employers appreciate this from a cost savings point of view, but it's killing your chances at a great retirement. Overall, I follow a concept that the Money Guy show discusses frequently. As mentioned in other episodes, this is my go-to podcast for personal financial information. They use the rule that you should be saving at least 25% of your income for retirement. Listen to their show for details, but basically, if you do that, your savings in retirement will allow you a lifestyle equal to or better than what you had when you were working. That said, more is always better in this realm. I don't know a person that would complain if they had a significantly better lifestyle come retirement. Another approach to know whether you're saving enough for retirement is what's called the safe withdrawal method. How this works is to calculate how much, quote, income you will need from savings and how much you feel safe pulling out of your savings in retirement. Then you use those numbers to back into what your retirement account value should be on the day you retire. According to Vanguard, a safe withdrawal rate number is between 3% and 5% if you plan to retire at age 65. If you plan to return far earlier than this, that number should be 3% at max. If you're someone who may not fully retire or retire until 70 plus, you could likely go higher than 5% for a safe withdrawal rate. But don't assume you will be able to work right up to age 65 for a multitude of reasons, from health to, frankly, age discrimination. I personally plan to work to age 65, but am building my retirement planning around forced retirement at age 59 or 60. So here comes the math. Let's use $40,000 as your planned withdrawal or income in retirement. This is the amount of money you will be taking out of either your personal savings or your retirement accounts. In order to hit a withdrawal rate of 4%, you would divide $40,000 by 0.04, and that gets you $1 million. So in order to live on $40,000 a year in retirement, you would need $1 million in your accounts in order to not risk running short in retirement. Here's the big catch. You need to factor in inflation, which as of recording this is completely out of control. Just most recent numbers, over 7%. But that said, on average, it's about 2 to 3% annually. So roughly by the time I plan to retire 25 years from now, $40,000 will be equal to living on $20,000 today. So I would say based on that, you'd want to plan on needing double the $1 million for retirement, or roughly $2 million. Don't let this scare you out of planning for retirement. Anything you save will be better than nothing, and it doesn't take as much as you think to hit that goal. If you take the historical average S&P 500 rate of return of 10% and you started at age 23, you would just need to save $275 a month from age 23 to age 65 to have just over $2 million. Think about this. If you get a company match of 50% of your contribution, you just need to save $184 a month, and the company will match that with $91, putting you at $275. That $185 a month works out to what I was roughly spending on cigarettes each month. Only $46 a week. So trust me when I say this, anyone can save for a great retirement. It just may take some adjustments. To that point, go back and listen to my personal finance episode if you haven't. We discuss a lot in that episode on opportunities to cut costs. According to an article in Barron's titled, "Here are 3 things 401k millionaires should consider before retiring early," $1 million nest egg may not be enough. For those planning to retire at age 65, let alone before traditional retirement age, a $1 million portfolio may be too little to cover retirement of 30 years or more. Harrison goes on to say in the article, investors should consider one rule of thumb often used by financial independence retire early adherents. To determine how much savings they'll need, they use the 25x rule. This guideline states that to retire, your savings should equal 25 times the size of your annual retirement expenses. In a $1 million portfolio, this rule assumes just $40,000 per year, which may not be enough savings for those with higher expenses or those who anticipate needing to cover rising healthcare costs. Also, keep in mind that 25% rule I discussed earlier is of household income. If you're married, it's 25% of both of your incomes. Single, it's 25% of your income. Have a side hustle, it's 25% of that as well. Again, I don't know anyone out there who would be mad if at the end they have more than they need or more than they planned for when they hit retirement. Plus, when you get close to retirement, you can always dial back your savings. That said, after you hit the 25% savings rate, don't sacrifice happiness just to keep saving more money. But don't go crazy either. Just because you have extra money above and beyond the 25% savings rate doesn't mean you should just go spend it. Just like dieting, if you cut too far, you'll end up frustrated, resentful, and ultimately risk failing. But if you don't cut enough, you may not hit your goals. A topic that comes up from time to time in discussion is the idea of how to build wealth and the idea of investing in stocks versus investing in other options like property, collectibles, or other non-traditional cash investments like crypto or now the new fad, NFTs. I personally think cash investments too often get looked down on. I think a big reason is the time it takes to build them to the point where they are working for you. As the Money Guy show always says, you are building an armory of dollar bills to work for you in the future. But over time, the power of your money invested in the market is so powerful. Let's take this example. If at age 23, you start putting $100 a month into an account like an IRA or a Roth IRA, or even just an investment account, get a conservative 8% rate of return annually. Keep in mind, with this 8% annual rate of return, some years you'll probably get 16%, and some years you'll get negative 8%, but on average you'll get 8%. You would have put $50,400 into that account, but the account would have hit $412,000 by retirement. That means your roughly $50,000 made you $362,000. The hard part is it will take over 10 years before you start to see the exponential growth. I can say with 100% certainty, once you start to see that exponential growth, 2 things are going to happen. You will wish you had been saving more money since day one, and you want to start saving more money that day as well. I think about this all the time. While I'm only 22 years from traditional retirement, first, I can still make a huge impact in my savings by pushing harder now. And second, I hope to live well into my 80s. So that means I have 40 plus years for my money to be put in today to still continue to grow. Once you pass that 10-year point of investing and get to the exponential growth, from year 20 to year 43, the growth from interest is astronomical. I know, people always say, but what if the market goes down? I'll lose money. Or what's the difference between the market and gambling? If you're in it for the long haul, meaning 5 plus years, risk is fairly low. It's obviously never zero. I focus my investing on core stocks for the most part and avoid speculative things. For example, consumer goods like paper products, food suppliers, or historical industries. All of these make and sell products that we use every day. That's not to say I don't speculate. I have bought some items that are highly risk, partially for the fun and interest, and partially for the potential upside. But I never let that high risk portfolio become more than 10% of my overall investments. As for what happens if it goes down, Well, on average, 8 out of 10 years, the market always goes up. Hence, the focus on the long term of 5+ years so you can ride out a few bad years. In an article from the Capital Group titled, "Time, Not Timing is What Matters," they share this example of how time in the market is more important than timing the market. They take 2 investors, each contributed $10,000 every year. One investor somehow managed to pick the very best day, the market low of each year to invest. The average annual return on that investment would have been 9.16%. The other investor was not so lucky and actually picked the worst day, the market high each year. Even with the worst investment timing, the average annual rate of return would have been 6.91%. At the end of 20 years, that cumulative investment of $200,000 had a value of $415,560. So even selecting the worst day each year to invest, someone who continued investing in the market over those 20 years would have come out ahead. It's important to note that regular investing neither ensures profit nor protects against loss. They go on to write, over the past 91 years, the S&P 500 has gone up and down each year. In fact, 27% of those years have had negative results. But what they show that is interesting is in a 1-year time frame, there are downs on average 27% of the time. And in a 3-year time frame, that number drops to 17%. Over a 5-year period, it drops to 13%. And then finally, over a 10-year period, the number of down periods is only 5%. According to an article on Investopedia, the S&P 500 has had an average annualized rate of return since its inception in 1926 through 2021 of 10.49%. The average annualized rate of return since adopting 500 stocks into the index in 1957 through 2021 is 10.67%. So the odds are in your favor, but you have to be saving and investing to take advantage of these things. Let's talk about some technical items now. These are items that took me years to learn, but are important if you're going to be managing your retirement. All right, so here's a few terms to know to help you learn and be a better investor. Asset allocation. This is simply how you divide your assets up across all of your investments. In asset allocation, the idea is to split your investments across types of items like stocks, ETFs, mutual funds, bonds, and cash. It may include some non-traditional items as well, like property, collectibles, or even physical commodities like gold. In the end, the goal is each one of these will perform differently at different times and carry different levels of risk as well. Remember, risk is directly related to the rate of return, so lower risk will always mean less return on investment, but can also mean less loss on investment as well. Take US T-bills. No real risk there that you'll lose your initial investment, yet you will likely not earn more than inflation, if that. So over time, your money will not grow much, while stock could get you 20, 30, 40, hell, even 100% rate of return over that time frame, but then again could also drop, hence the risk to return ratio. What age you are plays a big role in this. As you move towards retirement, the idea is to reduce risk by moving assets to things like bonds or even cash. In an article on CNN, they asked, "What's the best asset allocation for my age?" They discuss the simple rule of subtract your age from 100, and that's the percentage of your portfolio that should be kept in stocks. For example, if you're 30, you should keep 70% of your portfolio in stocks. If you're 70 years old, you should keep 30% of your portfolio in stocks. That being said, like we mentioned, if you have 5 or more years to ride things out, you can take on the added risk of stocks. Why is that important? Well, look at your retirement age of 65. If you're planning to live to 80 or 85, you have time to recover from bad years, so it may not make sense to have a portfolio with only 30% stocks. When it comes to getting close to retirement, I personally like the idea of going into your retirement with 3 years in cash across each of your investment accounts, and then no more than a 50-50 split between stocks and bonds or fixed rate of return assets like annuities. This gives you plenty of time if there's a down year or two to wait before selling additional assets that have lost value. If you're like me and you're using targeted retirement funds in your 401k or your IRA, what I've done is now that I'm over 40, I have moved a portion of my contributions from the 2045 target year fund, which is about the year I was planning to retire, and have started allocating those funds to a 2055 target year fund and even a 2060 fund. So as I get closer to retirement, a portion will not be as conservative as the 2045 fund. Targeted retirement year funds are an excellent way to start your investing trajectory, especially when you're young. They do all of the calculations on what you should be involved in. You simply have to contribute. It makes saving for retirement very easy. Automate your savings and automate it into one of those funds, and you will have a great path to success. Next is time horizon. This is a simple one. It defines the time before you expect to need the money you're investing. Simple as that. As we mentioned earlier, the longer the time horizon, the greater risk you can take on because you have more time to recover from a bad year. That said, the less time you have, the more conservative you should be. Now, diversification. Diversification, as defined by Fidelity, is the practice of spreading your investments around so that your exposure to any one type of asset is limited. This practice is designed to help reduce the volatility of your portfolio over time. 4 primary areas of diversification are domestic stocks, international stocks, bonds, and short-term investments like cash or CDs. Additionally, within this is what the investments are invested in, like commodity investments, which could be gold funds, copper funds, mining stocks, or the oil and gas sector, or other commodities. Or there are sector funds, like mutual funds or ETFs. ETFs are electronically traded funds that are a basket of stocks, similar to mutual funds, but traded more like stocks. These focus on specific industries or concepts like technology, healthcare, real estate, financial firms, or banks. You may pick these based on cyclical changes, like the idea that when one area is down, another is up, or how some parts of the economy move up and down less than others. Examples are consumer cyclical, which when the economy is good will be up, but if there's a downturn can drop equally or greater to that downturn in the market. Consumer cyclicals, these sectors can include retail stores, auto and auto parts manufacturers, companies engaged in residential construction, lodging facilities, restaurants, and entertainment companies. Companies in this sector include examples like Hyundai Motor Company, McDonald's, and the News Corporation. Then you have consumer defensive companies engaged in the manufacturing of food, beverages, household and personal products, packaging, or tobacco. This also includes companies that provide services such as education and training services. Companies in this sector might include Walgreens, Procter & Gamble, Coca-Cola, or CVS. Let's talk about risk tolerance. This is your ability and willingness to lose money in the stock market. Risk tolerance is tricky. There's the personal portion, meaning how much risk you're willing to take on. This would be referred to as risk tolerance. There's also the amount of risk you should take on, or your risk capacity. For example, when you're young and you only have a few $1,000s to invest, you have enough time to handle the risk, so you have a high risk capacity. But you may not be willing to take on the risk because you have so little saved, so your risk tolerance may be low. On the flip side, when you're about to retire, you may be willing to continue taking on risk. So your risk tolerance is high because you've seen the ups and downs and how successful you can be in the market over the years. But being that close to the finish line, why would you want to risk and stumble? Hence, your risk capacity is very low. Once you pull all of this together, you've got your strategy and you now understand what moves you need to do to become an investor. All right, let's take some examples. We're going to look at a conservative mix versus a growth-based strategy. In your conservative portfolio, you might do 14% domestic stocks, 6% foreign stocks, 50% bonds, and 30% short-term investments like cash. This would be likely a strategy that you would use close to retirement. The result is an average rate of return of 5 to 6%, with a worst-case 12-month period netting an 18% loss and a best-case year being 31% rate of return. Over 20 years, a worst-case average 3% rate of return and a best-case 11% over that same time period. While under a growth strategy, which you would likely follow for most of your investing time frame before retirement, you would do 49% domestic stocks, 21% foreign stocks, 25% bonds, and 5% short-term investments like cash. The result is an average rate of return of 8 to 9%, with a worst-case 12-month period netting a 40% loss and a best-case year being 77% rate of return. While over 20 years, a worst-case average rate of return of 3% and a best-case average rate of return of 15.5%. As you can see in these two examples, you see just how important time can be. Between these two strategies, the downside risk over 20 years is virtually equal, while the upside is over double for the growth strategy. This is why picking the right strategy and letting time in the market versus timing the market be your go-to process. All right, here you are. You did it all right. You have all the money you need to retire at 50 or 55. That's great, but here's the catch. Do you have access to this money? For your 401k and personal IRAs, the IRS allows penalty-free withdrawals from retirement accounts after age 59 and a half. So if you are under the age of 59 and a half, you would pay a penalty. So if you have no savings outside of those, you may have to keep working. There's no reason to pull money out early and pay a 10% penalty unless it's absolutely necessary. Second, did you plan for healthcare? If you don't have a good source of healthcare insurance planned out, you could blow through your money far faster than you realize. The cost of individual insurance when you have to buy it on your own in the open market can be astronomical. Private health insurance can easily be several $1,000s a month. And while you may be able to save a few bucks with a less stellar plan or an insanely high deductible, keep in mind, all it takes is one medical issue and you could have to cover a lot of out-of-pocket expenses. As a result, your only health insurance option may be to wait for Medicare. Medicare is health insurance for people 65 or older. You're first eligible to sign up for Medicare 3 months before you turn 65. So make sure you're planning for healthcare if you want to retire early. Saving is the easy part. The bigger picture gets complex. You are likely to be leaving the job market at your peak earning years. So once you're out, it can be very hard to get back in. If early retirement is something of interest to you, look into what they call the FIRE movement. Financially Independent Retire Early is what it stands for. This is a very complex issue and a very complex idea. I would highly recommend doing further research on your own if retiring earlier than the standard age of 60 or 65 is something you want to do. I would also highly recommend finding a financial advisor to help with your journey. Just make sure whoever you use is a certified fiduciary, meaning by penalty of law and lawsuit, they have to work in your best interest. To that end, any advisor who pushes products like high-cost investments, insurance products, proprietary items, high-cost annuities is probably not a good financial advisor. They are probably doing it for the profit they make and not in your best interest. Personally, the advisor I use has never tried to sell me a thing. They are a flat rate fee advisor who guides my investments and even gives advice on accounts not under their direct management and performs an annual review of where I stand on my path to retirement. This is really helpful for me to know whether I'm doing the right things. One thing you should keep in mind, and something I frankly never planned for, but just happened to me recently, is what do you do if your advisor quits, retires, moves firms, or in one way or another is just gone one day? Make sure you have a solid plan before that so you don't have to scramble. In my case, my advisor moved companies without notice, leaving my accounts unmanaged at the current firm. How this plays out and the level of service you get will tell you a lot about what your next move should be. In my case, the firm I'm at has not reached out or offered support, so I don't see them as a place I want to stay long term. And my advisor, frankly, has been less than responsive to my questions and concerns about moving accounts to the new firm. As a result, it has led me to start researching new options. Ultimately, that said, I did end up moving with my advisor because they did an excellent job after the initial hiccups. While initially they were a bit slow, easing my fears and offering the excellent level of service I have become accustomed to, they ultimately met my expectations. All right, a little advice to anyone out there who is in a position to provide services or support. Basic things could have prevented my frustration and vice versa nearly led me to move to a new advisor or firm. I'm not asking to have my hand held, but put some level of effort above and beyond generic emails into things. That would have gone a long way from the start. This is why it is so important you be an active participant in things and not just pass your money to an advisor and ignore what happens. While I was totally freaking out, in the end, I needed to remind myself my financial plan and investment strategy was very solid and built for the long term. So taking a month or even a few to do things right wouldn't ruin anything, which is ultimately what I did. I slowed down, I assessed the situation, and made my final decision. In the end, you need to make sure you have a plan for the long term. This needs to include all contingencies, not just investment strategy, but true legacy planning. If you're married, this must include clear communication between spouses. Don't ever make assumptions. What is your plan if the spouse who's the primary money manager dies? This is a great reason to have an advisor or a trusted friend or family member who can step in to help through this transitional period. This is a topic I'll discuss more in an episode on death and loss. But what I can say now is make sure, especially if you're married, you and your spouse are equal participants in everything you do so that if something happens, you each know what is going on. Above and beyond just knowing what's going on, make a plan for what happens if one of the spouses passes away in retirement. Will you lose their Social Security benefit, their pension? What costs are you going to need to adjust? Look at it this way. If the two of you have a combined retirement income from pensions and Social Security of, let's say, $3,000, and one of you dies, and that number goes down by even $1,000, you will have to be able to afford your living expenses on $2,000. I often make this comment to people who are married who tend to forget that when there's two people living in a house with dual income, your expenses don't suddenly drop by half if one of them leaves or dies. Your cable bill is still going to be the same, so is your mortgage. Hell, even your heating and electrical will likely be close to the same, if not the same, if one less person is in the home. I point this out all the time that as a single person, I bear the same level of expenses as if two people lived in the house I have. The same goes in retirement. Will you need to sell the house and downsize if one of the spouses dies? Will you need to get rid of an extra car or maybe the toys like the boat or the snowmobile? These are all things you should think about when you're going into retirement. Another thing is, should you take the survivor benefit that your pension offers, even if it might mean a lower pension payout if you don't die? That might be better than the alternative of no pension if you pass away. And for God's sakes, do not assume one spouse will outlive the other. You can't predict things like that. Hell, it happened to one of my best friends recently. Did his wife expect him to die at 37 in a tragic accident? Absolutely not. But they had been planning for something like that and had a plan in place. She had a great support network of family and friends and was able to work through it financially. But again, this only happens if you talk about it with your spouse and you have plans. Think of planning for retirement like we did for the maintenance phase of post-dieting. It's not fun or glamorous, but it's more important than the diet itself, or in this case, it's more important than saving for retirement. Yes, saving for retirement is important. Without saving, you can't have a retirement. But if you don't plan on how to live through retirement, you can easily make mistakes that put your comfortable retirement in jeopardy. All of this requires a lot of thought and care and should be considered from the very beginning of your career. All right, one last final topic I want to touch on today, and that's Social Security. I personally operate under the assumption that I will have to fund 100% of my retirement and that I will never see Social Security. If it's there when I retire, great, then I'm that much better off. But realistically, I don't expect it to be there. So what about you? Well, if you are 50 years of age or older, I would say you can safely assume that Social Security will be there for you. Between 45 and 50, I might put the odds at 50-50. Under 40, I would operate on the assumption that there will be no Social Security when you retire. All right, as for other types of guaranteed retirement funds like pensions from both public and private entities, I would never depend on them for 100% of my retirement either. Unless there is a guaranteed cash value portion, which even that can be at risk, there is no guarantee your pension will be there in retirement. What happens if your pension fund goes bust? Yes, there are safeguards in place in the United States to prevent you from losing all of it. In the US, every defined benefit plan is insured, at least to a point. Most will receive all or at least most of their company's pension, even if the company goes bankrupt. However, in some cases, it may not be every penny you expected. A federal insurance agency called the Pension Benefit Guaranty Corporation, pbgc.gov, takes over the pension payments if your employer goes under or the pension plan fails. While this sounds great, there's a catch. The Pension Benefit Guaranty Corporation maximum annual payment, which rises with inflation, is $54,000. That was for 2021 and workers who are age 65. Don't think that could happen to you or your employer? Take a look at this story from 2018 as GE began to implode. Like other companies, GE has accumulated a significantly underfunded pension. But like most things lately at GE, its pension shortfall is far worse than anyone knew. Not only does GE have the largest pension deficit among S&P 500 companies, that deficit is $11 billion worse than the next closest company. According to the Dow Jones S&P indices, they have a $31 billion shortfall at the end of 2016, the last time numbers were available. GE's pension nightmare is the result of years of inattention and of historically low interest rates that have driven up pension liabilities around the world. This is not just a math problem. More than 600,000 current and former GE employees are relying on these critical retirement benefits. According to an article on Investopedia, the U.S. Department of Labor's Employee Benefits Security Administration, EBSA, maintains a list of plans whose funding status is classified as critical, critical and declining, or endangered. In 2020, 121 plans were in critical condition, 65 were critical and declining, and 61 were endangered. A critical plan is less than 65% funded. A critical and declining plan is expected to become insolvent within 15 years, and an endangered plan is less than 80% funded. So the responsibility is on you to take control of your retirement, as with anything you ultimately control the outcome of. I hope this goes without saying, but nothing I have said is to be taken as specific direction or advice. I am not a licensed professional, and everyone's situation is very different. These are my personal thoughts and experiences. The podcast and all associated social media are for information purposes only. This should not be relied upon as a basis for investment decisions. Before making any investment, you should carefully seek independent legal, tax, and regulatory advice. In particular, you should seek the advice of a licensed financial advisor regarding the sustainability of the investment products, taking into account your specific investment objectives, financial situation, and any particular needs and your ability to assume the risks involved before you take a commitment to purchase the investment product. This podcast and documents are for general evaluation only, and any recommendations made herein does not take into account the specific investment objectives, financial situation, or particular needs of any particular person. While the information provided here is believed to be reliable, it has not been independently verified by myself. As we've said from the beginning, make sure you're an active participant in all aspects of your life, mentally, physically, and financially. It is how you will be successful. Thank you for listening. Please join me again for future episodes. You can contact me at parachuteadvicepodcast@gmail.com. Again, that's all one word, parachuteadvicepodcast@gmail.com. You can also follow me on Instagram at parachuteadvice. Again, thank you for listening, and please like and subscribe wherever you get your podcasts.